Up to this point, I have talked to you about the value of a retirement annuity, those invaluable mortality credits. And the older you are when you start receiving those guaranteed income paychecks, the more mortality credits you receive. Well, now I want to tell you about a retirement annuity that can actually help to save money on taxes in retirement. So is that even possible? Well, we're going to talk about that now. So in 2014, the U.S. Treasury and the IRS combined efforts to create a deferred income annuity that could provide you tax benefits in retirement. It's referred to as the Qualified Longevity Annuity Contract, or QLAC for short. Now, this QLAC actually has special features that the deferred income annuity does not offer. By the end of this video, I'll give you the facts so that you can make an informed decision about whether a QLAC is the right fit for your retirement portfolio. Hi, my name is Darlene Hartman. I'm a CPA and founder of D. Hartman Consulting, LLC. For the best retirement annuity advice, subscribe to my YouTube channel and hit the notification bell so that you can receive notices anytime I post a new video. Yep, you heard me right. The QLAC can actually offer you more tax benefits in retirement than a DIA. But in order to enable these benefits, a QLAC must be included in a qualified account. So you may say, what is a qualified account? That would be your employer's benefit plan, which includes a 401k, a 403b, or a government 457b plan. It can also be included in a traditional IRA. But a QLAC cannot be included in a Roth IRA, a taxable account, or a Secure Act inherited IRA. So what is an inherited IRA? So let me just give you a situation. So let's say you have a relative who passes away and named you as the beneficiary of their qualified account. So you inherit that qualified account. Inside that qualified account, you're not able to add a QLAC. Now, let me remind you about what a qualified account is. So contributions to a qualified account are pre-tax. So you pay no taxes on that money when you put the money into the plan. It grows tax deferred. Note that I said deferred and not free. The government is going to get their money from you for those qualified accounts at some point. Speaking of that, when you make distributions from those qualified accounts, they're 100% taxable. Now, by the age of 72, if you have not been making distributions from the account, or even if you have, the IRS has actually established a code which tells you what percentage of required minimum distributions you need to take from your qualified accounts each year. So it doesn't matter if you need that money or not. You're required at the age of 72 to start pulling money out as in accordance with the Internal Revenue Code. If you have a QLAC in a qualified account, what that's going to enable you to do is to wait up to 15 years or the age of 85, whichever comes sooner, before you start making required minimum distributions from the QLAC, which would be in the form of your guaranteed income paychecks. So you're basically getting a triple bonus with a QLAC. So as we mentioned with the DIA, and it's true for a QLAC, you're basically going to cook that money for either 15 years or up to the age of 85, whichever one comes first. So those income guaranteed benefits are actually going to increase because you've been cooking it for a certain number of years. Then also, you're not having to pay taxes on the amount that's in the QLAC between the ages of 72 and 84. That's if you're waiting until 85 to start those guaranteed income paychecks. So you don't have to worry about pulling out money, a required minimum distribution between the ages of 72 and 84 and paying taxes on that money. The third benefit would be the fact that if you wait till the age of 85, you're going to be receiving some big time mortality credits in the form of guaranteed income benefits. Now, we know that we're talking about the IRS here, so there are QLAC disadvantages. the IRS has actually placed a limit on how much can be put into a QLAC. So currently it stands at either 25% of the total amount that you have in all of your qualified accounts or $130,000. So you cannot put more than $130,000 into a QLAC. Keep in mind that is inflation adjusted, and it's adjusted in $5,000 to $10,000 increments. Leave me a comment in the section below and let me know if you currently hold a QLAC in your retirement portfolio. And also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and hit the notification bell so that you can receive notices anytime I post a new video. Now you may be asking, how exactly does this work? So let me paint a picture for you. Let's say you're 72 years old and you are still working, making enough income to pay your basic living expenses from your job. Well, insert IRS, and the fact that at the age of 72, they're going to require that you make those required minimum distributions as in accordance with the Internal Revenue Code. That doesn't matter if you need that money or not, you still have to make those required minimum distributions. And those required minimum distributions can actually put you in a higher tax bracket, creating more of a tax burden for you. So if you think about it, if you have a QLAC and it's not required to pay out required minimum distributions until the age of 85, by then, hopefully, you're fully retired and your income is relatively small. So now you're paying taxes on the QLAC at a lower tax bracket, which relieves you of some of that tax burden. And also, you probably need the money. Now, keep in mind, it's not a huge benefit right now. So again, we're only talking about $130,000 per individual max that you can invest in a qualified longevity annuity contract. But there are some other tax planning strategies with respect to the QLAC annuity. So you can definitely do joint or single life, and the joint life is highly encouraged to give your spouse that additional benefit. But in addition to that, if your spouse owns a qualified account, he or she can also have a QLAC in their qualified account, which would give your household a total maximum benefit of $260,000. If you're wanting to ensure your income and therefore your retirement, and you like the idea of having some tax planning strategies in your qualified accounts, then the QLAC is the right fit for you. If you feel like you cannot retire properly without a QLAC in your retirement portfolio, be sure to click the link below to apply to become my client. Also, if you enjoyed this video, be sure to share it with family and friends. Don't forget to subscribe to my YouTube channel, hit the notification bell so that you can receive notices when I post a new video. Give me a thumbs up. Thank you for watching. Let's get the conversation started on how to live your best retirement while not outliving your money.